afternoon, everyone. I'm Pamela Hastings, and we welcome you so warmly to another Barometer Readings webcast. Joining me, as always, on this webcast is David Burrows, our Chief Investment Officer. And on this webcast, Dave will be pleased to provide a macro overview. And of course, at the tail end of the conversation, we will be ready to address those questions. So don't be shy. You can send those via the Zoom chat or Q&A, and we look forward to seeing you. Hi, Dave. Nice to see you. Of
Hey, Pamela, thanks for hosting today.
course.
And thanks everybody for joining. Why don't we kick off? Here we are, we're the middle of June. April was a down month. May was an up month. But overall, market's been pretty positive over the course of the year. S&P today, I think, closes at a new high, led by some of the very big mega caps. Certainly the semis have continued to be pretty strong. Apple had a great day today after months of consolidation. Market liked their developer conference yesterday and the prospects for AI in the operating system. I want to delve under the surface today because while the indices are hitting new highs, there's definitely our haves and have-nots in this market. As always, we're trying to focus on leadership, get to the parts of the market that matter. It's interesting. I was talking to the team this morning, and really trying to suss out where we may be seeing new leadership emerge. As far as I can tell, really tough to find new strength in this market. There are some pockets of weakness, but just so off the top, we continue to be in the structural bull market that started in the US in 2013. And despite several cyclical bear markets, market is working its way higher. We've stayed above this rising 200-week moving average pretty consistently since the beginning. This looks very different than secular bear market where we're crisscrossing back and forth in very significant deep troughs. Certainly they felt like deep troughs, but as we got up and out of the cyclical bear market that started at the end of 2021, market has been working its way higher. So since the beginning, it's up about 248% over 135 months. Sounds great. However, really doesn't compare at this point to the 80s and 90s, 1,300% over 217 months. Back half of that bull market, really the trajectory tipped higher, and that tends to be the case. My guess is we're sort of 2/3 of the way through the structural bull market, and lots of things that are working. When we look at the S&P index itself, the lows in October of 22. Really, we saw the market start to broaden in the middle of March. So we spent a lot of time measuring against that, how things have gone since then. We've had a couple of distinct legs higher with some corrections. And as we sit, S&P is sitting here basically at new highs, although some of the internal indicators are not pointing to everything. There's some areas of strength and some areas of weakness. When we look at the equally weighted S&P, it tells us, a slightly different story. Since we made the high in the early part of April, S&P equally weighted, meaning every company, 500 companies equally weighted in the index, has been unable to make a new high. So we keep an eye on that. We are stock pickers, but we are tactical when it comes to managing our exposures. And we try to make sure we're staying in sectors that have improving relative strength versus the market. Things that are being revalued, where multiples are expanding. And that's not the case for every part of the market. Now, outside of the US, global stocks, continue to behave pretty well. The Nikkei, after 30 years of a disinflationary world and deflation, has been marching its way higher and continues to be very strong. The Indian market had a wobble earlier in the week when we got the results of the election, although a coalition was formed, and markets are basically back to highs. The Euro Stoxx 50, which is 50 major mega cap stocks coming out of the Euro area, marched higher early this year. We spent the last 3 months consolidating, when sitting, more or less near the gains, depending on the regional market, some a little better, some a little worse. But that's really important because this was the first new high since 2007, likely beginning of a new longer period of strength. Certainly, we've had strength in a few Asian markets. Taiwan is one in particular, driven by Taiwan Semiconductor and the impact that they're having in the world of fabbing chips for AI, trading very close to new highs for the year. And the TSX, which as of last month was making new highs. We pulled back a couple of percent off the highs, but in general, again, early stages of a new bull market. So when we look at equities around the world, the first thing that I would say is, in general, we have been seeing more markets join the rally than markets giving up strength. And that's the very definition of improving breadth. Doesn't mean it happens every day. It doesn't mean it happens every week. But we have seen a number of markets join this equity market rally. And I think that that's, pretty bullish. In the world of fixed income, we've been pretty bearish since 2020. We went from a world where you had falling rates, which meant rising bond prices and a coupon payment, to a world where rates are moving higher, higher highs and higher lows, which has continued, which has meant lower lows and lower highs for bond prices. So the long end of the US bond market at the worst point was down 53%, not much better than that now, still trading below all the long-term and short-term moving averages. So we've said sort of over and over again, until some of those things change, we're in a bond bear market. But the difficulty is, of course, that people do what they've learned to do over time. And anytime rates backed up over the last 30 years, it was time to buy bonds for the inevitable fall to a lower low. And people certainly have been buying bonds, but it's been a very different story than what they've been used to. On this chart, we're highlighting the length of the drawdown in the aggregate bond index in the US. One of the things, these things does not look like the others. And I would say that people in general should take heed of that. In a period of disinflation, one of the things we hedge against is falling prices, and bonds were a great way to do that. In a world of inflation, we need to protect against the erosion of our purchasing power, and companies have a tendency to be able to raise price when there's inflation, which means their profits keep pace. And so stocks versus bonds, since the bottom in rates has been a very clear upward trajectory, we've preferred stocks versus bonds. And, when we go back and look at, what happened the last time we saw this bottoming in yields, we know that stocks really outperformed bonds for a long period of time, and it was dividend growth stocks that really led. Okay, so our focus in our income mandate, where we're trying to hedge risks and generate cash flow, has been less about owning fixed income, hedging against falling prices, and more about focusing on maintaining purchasing power through dividend growth. And just a simple graphic, since March of 2023, as we really started to see these themes broaden out, the aggregate bond index down 1.5%, where our tactical income strategies up just about 28%. And over that period of time, inflation would have been ranged between 3.5% and 4%. So clearly, the aggregate bond index is not keeping up with inflation. It's being hurt. Of course, it attracts a bunch of tax. Income strategy is certainly doing its job. So in simple terms, we continue not to like bonds. Now, another way that we hedge against inflation is to own things that go up in price in an inflationary world. Commodities in general have been moving higher in price. This is an equally weighted basket of commodities, about 30% energy, about 30% agricultural commodities, and about 30% metals and materials. And it's in general been working its way higher since 2020. You can see it pulled back a tiny bit over the course of this month, which never feels great, but it's sort of irrelevant in the scheme of things. Certainly commodities relative to bonds are outperforming. And frankly, we're in the early stages of commodities relative to the equally weighted S&P outperforming. You can see the moving averages tipping higher here. These are monthly bars. So we don't want to ignore that. But in general, people have been doing what they've learned over the last decade, which is anytime you saw strength in commodities to sell them, and anytime you saw weakness in bonds to buy them. And that's really not working out so well, I think, for people who are looking backwards. So over time, we're working our way higher since the beginning of the year. Equally weighted S&P's up about 5%. TSX is up about 6.7, the aggregate bond index down 1.25, our income strategy up 14.7, and the equity strategy up about 14.9. Global strategy, global equities ex-US, the index up about 7. The global global fund, up 9.3%. So it's doing its job. So the big picture, continues to be that equities are good asset class. It's broadening in general. We like commodities as a hedge against inflation. And we're picking our spots. We're choosing not to own a lot of bonds. That's just purely because it does not appear that disinflation is a significant risk at this point. We don't have to be everywhere. Our job is to focus on leadership. Now I'm watching for change to see if there are new areas we need to add exposure to, or on the other hand, if areas that we're focused on start to break down, because our job is to be tactical, and our first and number one job is not to have a big give up. So we're trying to take a tactical approach. Our view is that 70% of the return comes from being in the right neighborhood, places that are seeing a rising multiple, and then we populate using securities that are good getting better, where we can see fundamentally are improving in their income statement, their balance sheet, and where price is supportive. And the name of the game is finding areas where over time more and more stocks are participating. It means it's a healthy part of the market. When we see deterioration, and this is important, doesn't mean we're going to go sell everything, but it means we got to watch our positions, right? The eggs in our basket. And if we start to see weakness, we got to stop ourselves out. If we see deterioration in trend, stop putting any new positions on and wait until we start to see expanding breadth, right? So as we said a week ago, we highlighted that some of our short-term indicators were negative. Percent of stocks trading above the 50-day moving average in general around the world had been weakening. Percent of stocks trading with positive weekly momentum had been coming off the boil. Percent of stocks making new highs versus new lows a little weaker, and percent of stocks trading above their 150-day moving average or 30-week moving average a little weaker. Again, that doesn't mean everything. It just means there are some areas of weakness. We highlighted that the percentage of stocks trading above the 50-day moving average on each successive push higher recently has been coming in lower, meaning that the market was becoming more concentrated. Well, that continued on this week. Percent of stocks in uptrends in the NYSE moved down by about 6%. What does that mean? Just over 50% of stocks in the market are in clearly defined upward price trends, higher highs and higher lows. But it also means just about 50% of stocks are not. We only want to own companies where price supports our view. So if price is weakening, even if we're bullish, we're not staying. Now, as it sits, the weakness has been pretty concentrated in a few sectors, and we've been highlighting those sectors. That really hasn't changed very much. But under the surface, in general, these indicators have been getting a little mushy. So when we come into summer, the end of May, there is a commonly held belief, sell in May and go away. There's certainly some of that going on. The month of May, the S&P was up about 5% after being down 5% in April. That would be a cause for some institutions to say, well, bonds have been sloppy, stocks have been strong, we're going to rebalance, move a little money from the stock portfolio has done well into the bond portfolio has done poorly to average out our prices. But here we are now, 10th of June, and that has continued. So we watch for sign of change here. What this means for us is that we're very hesitant to put on any new positions while this data is weakening. It may just be a blip, and my guess is that may wind up being the case, or it may turn into something bigger. But if you stop putting on new positions and you to be critical of your existing positions to make sure they continue to meet your tests, then if something breaks down or something starts to sell off, you wind up with a little more cash in your hands, and you got opportunity if things continue to weaken. So that's the backdrop from an equity perspective. So let's look at the leadership groups. Financials, a very long-term picture back to 2008, show us in the early stages of a new bull market. We've gone through the market's view that the Fed would tighten for a long time, and we marched higher. We a little lower in the month of April, a little higher in the month of May, a little weaker right now in the month of June, but we're trading very close to highs. This is a big, important sector of the market in the US. Certainly it is globally. Europe dominated by large banks, and certainly in the US, some very large. We've focused on what we consider to be strength, and JP Morgan has been strength. While the US banking industry took until 2020 to make new highs after 2008, JP Morgan made a new high in 2013, 7 years earlier. Arguably the strongest balance sheet, best management, best technology, and relative strength has been fairly steadily higher. It's pulled back a little bit off the highs, but clearly it's in higher highs and higher lows. The bank, if I compare JP Morgan's share price performance versus KBE, which is the large bank index, it's from the lower left to the upper right. You know, as of yesterday, JP Morgan was making a new relative high versus the banking index. So our belief is own the banks that are good, getting better, own things that are the leaders in the industry, because they tend to be revalued the best and they tend to be the most resilient when you see a little pullback. In Canada, National Bank and RBC have been the two champs, our two biggest positions, making relative strength new highs on the back of strong capital markets and wealth management for RBC. These continue to behave really, really well. We've talked about property and casualty insurance. The biggest position in the firm continues to be Fairfax Financial. Despite that one day where the short sellers report came out, stock sold off and regained its new highs within less than 2 weeks. And here we are trading basically again at relative strength new highs versus the market. And life insurance has been doing well, and in particular Manulife Financial. 6% dividend with about a 10% growth rate dividend, pretty attractive. So common characteristic of all of these are dividend growers. Companies that have an ability to set price and raise their dividend. JP Morgan's raised its dividend twice so far this year. And then also, in this financials group, the exchanges have been performing well. We haven't talked about this for a while, but this is another large holding at Barometer. It's a 2.5% dividend, growing its dividend around 10%. If we think that equity trading volumes are likely to be strong, if we think that there are going to be mergers and acquisitions deals, we want to own the exchanges because they benefit from fees and from trading data. And TMX has a very unique commodities trading platform that they've been having good luck with, called Tradeport. So these companies have been doing well. It's really important that we high grade, that we try and target the leading companies and the leading groups. It adds value. And so even though the financial pulled back a little bit over the last couple of weeks, actually these holdings are hanging in very, very well. Get to industrials. Now, industrials broke out in 2023 to new highs. We pulled back a little bit over the last 3 weeks. Not a big deal. You can see higher lows and higher highs pretty consistently. We'll see whether we hold in here. This is an equally weighted basket of industrials, the VIS ETF. We've talked a lot about aerospace as being an important area. Howmet and General Dynamics have been our two big positions there. And sadly, there is increased spending all around the world on defense. And these companies have very good long-term visibility on growth. Also, the mid-sized machinery companies that are selling into infrastructure, like the electrical systems, are doing well. And this AIRR is made up of mid-sized companies selling into sort of the industrial renaissance in the US. And we've got a fair bit of exposure here. So industrials continue to behave pretty well. On materials, you can see materials are pulled back a little bit. It feels like more than that, but this is the XLB, which is made up of metals, it's made up of aggregates, it's made up of chemicals, it's made up of all the different basic materials. It's pulled back a little bit. Again, we continue to see higher highs and higher lows. So we'll see what happens here. If we look at the miners, for instance, the last 2 weeks, they pulled back, but they continue to be in a very solid uptrend. They move in percentage points fairly substantially at times, but nothing to see here as far as broken trend, and gives us good hedge against inflation. On energy, energy's been consolidating over the last 6 or 7 weeks. On one hand, the oil producers have been a little weaker. On the other hand, the gas producers a little bit stronger. And the infrastructure companies behaving well. But on a small pullback in oil price, look at what the speculators have done. They've taken their net long on futures contracts down to levels that haven't been seen since the sector blew up in 2014. Now, I would say we're a long way from seeing any kind of blow up. The technical price patterns on the stocks are good. The cash flow is fantastic. The dividend growth is very strong. And today there was reaffirmation of the expected demand growth for 2024 and 25. The infrastructure companies are having a really good move. We own both Pembina Pipe, 6.6% yield, and AltaGas with a 4.8% yield. They're both benefiting in this increased volumes. So another sector, I think, that protects us from an inflation situation. Now, technology. This is the large cap technology ETF XLK. It's made up of the very largest of large cap names. Microsoft is 24%, Apple's 19%, Nvidia's 4.6%, Broadcom's 4.5%. We've talked about the fact that relative strength has waned really since the beginning of the year, but has picked up over the last couple of weeks and had a very good day today. The XLK was up 1.65%, probably partly on the back of Apple, but Microsoft, Nvidia et al. Have continued to perform well. Nvidia, again, in the top 10 holdings of the firm, trading better than 99% of all the stocks in the S&P over the course of the last 52 weeks. It went through its split this week. Our original cost was $140, so I guess that makes $14 today. And stocks trading at 120, so it's been a great performer. Avago, the old Broadcom, trading better than 94%, continues to make new highs. The semiconductor is really strong across the board. Qualcomm is the other holding that we have in this group, trading better than 96% of companies in the last 52 weeks. So semis, an important group to watch. Internally in the semis, there are haves and have-nots. The largest of large caps have done very, very well. Taiwan Semi is another that's done quite well. Microsoft has been a beneficiary of the move to AI. It's continued to trade very well. It's basically at new highs today. In general, all of these are dividend growth stocks. And the dividend growth ETF, TDIV, which is made up of technology dividend growers. So you saw, we talked about this last week and the week before, the relative strength has tipped higher. This is the first group that started to really gain from a relative strength perspective over the last couple of weeks. These are the big cash flow generators. And then to round out the obvious AI winners, Google continues to be very strong, and Meta Platforms, which arguably is probably third in AI inference, is also doing quite well. So we're high grading in technology. But it doesn't mean everything's working. This is the ARKK ETF, made up of the innovators, many of them not profitable. You can see the more speculative tech companies continue to cave from a relative strength perspective. Not to say Tesla's is speculative, it's 8.5%, but it was down about 3% today and has been underperforming, so we have no exposure there. Utilities have had a good move really since February on a relative basis. We do have holdings here. NextEra was down today about 4%. We'll see sort of what comes out of that. That's the largest one in the group. But in general, we think that the utilities are acting pretty well. But when we look at weaker breadth, one of the things we want to know is where it's coming from. And are there other signs that maybe investors are becoming more cautious? One of the things we would look toward would be what's happening in the defensive sectors, or the sectors that act more like bonds. If we thought that the market was weakening, and if we thought the economy was weakening, you would see money rotating money managers' hands from offensive type positions like financials and industrials and materials to defensive sectors, sectors that are less economically sensitive, acting a little bit more like bonds. Telecom would be one of those. But here we can see the telecom sector hitting new relative strength lows today. Consumer staples, well, that's not a very attractive relative strength profile. Really, this is the PBJ food and beverage ETF, made up of a lot of the basic consumer staples companies, really particularly weak. Consumer discretionary actually isn't much better, even though 23% of this index is Amazon. It's been a weak performer. Our big positions are Amazon, Costco, Dollarama. These are all companies that really are benefiting by a consumer that's being a little bit more cautious. We think that makes a lot of sense. Healthcare is a defensive sector. No real pickup in relative strength here, although, if you cherry pick, Eli Lilly would be the largest holding in the XLV healthcare ETF, and Lilly is our single biggest holding in healthcare, hit new relative and absolute highs today. Real estate investment trusts tend to be a little bit more defensive if you think that you're going to get falling rates. There's no defensiveness showing up here. Relative strength continues to be very sloppy. And the financiers of the REITs, the regional banks, are making relative strength lows here as well. So, a picture tells 1,000 words. The sectors that have the strongest breadth in the market continue to be, financials, industrials, materials. These are the groups we're focused in. At the other end of the spectrum, the sectors that have the smallest percentage of stocks in uptrends, healthcare, consumer, leisure, auto, some areas of healthcare like biotech. So we're seeing a real split in this market. We're watching for new signs of leadership. The groups that we're in continue to behave pretty well. Nothing goes up every day, but I think that in general, the leading stocks have continued to perform well. It's a market of haves and have-nots. And from sector weight perspective, our sector weights aren't changing dramatically. They continue to be quite strong. Things that we would watch for signs that there's concern in credit markets. We're seeing that credit spreads for investment grade and for high yield, continue to be very narrow. Bond investors are not demanding a premium yield to take corporate risk. And of course, we still follow volatility every week. And we've highlighted over the last few months that volatility has been in the range that it tends to be in during cyclical bull markets. So 1991 through 98, volatility tended to be between kind of 10 on the low end and 15, 16 on the high end. Between 2003 and 2007, before financial stocks started to get into trouble, same thing. 2012 through 15, leading into China's slowdown period, very low volatility. In 2016, 17, 18, the same. So far, this has been a relatively short period of time. Our view has been we probably have a couple of years in front of us of relatively low volatility period. We'll see. In the very short run, statistically, when the market's been strong into the end of May, June, and the rest of the year tend to be quite strong. We'll see. So in general, we continue to be bullish. We're not adding any new positions. We got pretty good exposure in the sectors that have been performing well. We can't point to any really new areas of market leadership. We'd love to continue to diversify out our holdings if we see some new strength. If our existing positions start to break down technically, you'll probably see us wind up with more cash. And our job is just to monitor these things actively, day by day, watching for change. So not a lot new in this week's webcast, but it's just, I think, noting that absent any improvement in the data, we're probably going to be sitting on our hands in the next little while, and watching for new signs of strength. If things start to weaken, we'll certainly get defensive, as we have done historically. When the market gets weaker, we do tend to get defensive pretty quickly. But in the meantime, sometimes doing nothing is the best is the best strategy. And with that, Pamela, if there's any questions, certainly we can answer them.
Hey, Dave, of course. So we have our first question reads, David, the price of oil has blown through key technicals, including the 200 moving average. It has even caught oil experts off guard. Are you concerned? Are you tweaking your energy portfolio? If not, what would you look at to start lowering, what would you look at for you to start lowering energy weighting?
Yeah, so our big thing is we're watching, first of all, breadth, and breadth has contracted in the energy sector. In general, the weakness has been in some of the weaker names. As I highlighted, the gas names have been behaving better. Natural gas has been very strong. I mean, it's recently moved up in the last couple of weeks from 240 to 315. And seasonally that tends to happen. The large cap dividend payers have pulled back a little bit, but they certainly haven't broken any major technical levels at all. You have to remember that both material stocks and energy stocks trade in a wider band than some other sectors. So we watch it, but the fact that energy breadth has been contracting, it means that we're not adding any new positions. And then we've got to manage each of the individual positions along the way. But for the big boys, the positions, they pulled back within trend, but they certainly don't look broken. We don't own oil as a commodity itself. Interesting, though, to see that there's virtually no speculation built into the oil market. I would actually argue that hedge funds, which are about 10 times the size of the physical market, have been speculating to the downside. We'll see, but the energy equities have behaved better than the energy itself, and that's what we're focused on.
Thanks so much, David. The next question comes from Larry. He asks, "Hi, David. I find MSFT a little high on trailing earnings on a PE basis. Is the market anticipating significantly higher earnings going forward, perhaps related to AI?"
Yeah, look, we have to be careful sometimes on earnings multiples in some of these companies. For one, the analysts in general, when things start to inflect, tend to remain cautious and then just raise their estimates as they get hit. It has been the case that analysts have been too bearish. I don't mean bearish. They haven't been bullish enough. Microsoft has continually beaten estimates. I think there is some question as to how much impact, for instance, Copilot could have on revenues. At this point, they're just really selling Copilot to very, very large enterprises. But arguably, it could be a big driver for revenue going forward. We watch a couple things. We watch the estimate revisions, which in general have been higher. And we watch price to say, is it doing what we would expect it to do, given what we think we know? And both have been strong. So we try not to get too caught up in the multiple itself. It's more about what's happening to estimate revisions and price that we care more about. Strong stocks have a tendency to get better faster than you think. And we all always worry about what could go wrong. And that's why we spend a lot of time watching price, because if it starts to behave in a sloppy technical manner, given, a bullish fundamental view, that would cause us to question. But so far, it's been incredibly resilient.
Dave, final question comes from John. He wants to know if there are any notable sells that Barometer took this past week. And perhaps you could comment on the industrial sector.
Yeah, it's interesting. I was in the West last week, Monday, Tuesday, Wednesday. In fact, I did the webcast last week from a restaurant in Calgary. It surprised me, given some of the sloppiness, that we really didn't hit any of our stops. I think we lost one small healthcare position. We had a small position in Dexcom, which is diabetes insulin monitoring real time. and that had some bumpiness and was gone. Smaller company. None of our large holdings, which is why our sector weights didn't change very much this week. No, we're not adding anything either, but at this point, no, nothing has hit major stop levels.
Dave, that concludes the questions we've received this afternoon. As always, thank you so much for your wonderful barometer readings weekly. Everyone enjoys them. And with that, I will leave you with the final word.
Yeah, look, you know, when I highlight the fact that we've seen, you know, weaker breadth in the internals of the market, it's for a couple of reasons. You know, it causes us to really scrutinize all of our positions to say, is something really changing? By the fact that the defensive sectors continue to be sloppy, tells us that there's no major economic concerns at this point. You know, volatility and credit spread staying low, same thing. You know, May, June, market bounces around a little bit. The fact that some materials and energy stocks have pulled back a little, you know, the metals can pull back 10% pretty easily within trend, and it feels bad, but it's just what they do. So, you know, I think that there's a lot of people looking forward to the Fed's comments this week. They're likely to say that inflation continues to stay sticky. Labor has continued to stay very strong. And so, you know, they're going to continue to job roll, and the fact that they're going to take longer to lower rates. We should be pretty happy about that. You know, if they were concerned, they'd cut rates, but they don't appear to be at this point. So, you know, market had a great rip higher from October through really the end of May. The fact that we're chopping sideways and a little lower on a few things shouldn't be a big deal. The market appears to be very resilient. Anytime that there's selling during the day, tends to find its footing, and some of the leading stocks, you know, work their way higher again. So we'll continue to watch, and you know, I haven't posted a lot over the last week because frankly, not a lot's changing. But we'll watch for change and highlight you as we go. If you got questions, please don't hesitate to call us or send us a message. We've had some great conversations over the last few weeks with some folks who have decided to do some work with us, and we're always happy to meet new people. So Pamela, thanks so much for hosting, and thanks people for joining, and we'll look forward to talking to you again next week.
Thanks, Dave. See you next week.